Hi, I'm Marc Childs from FMCG Institute. This is the third video in the Barcelona Masterclass series, Rethinking Trading Strategy. In this video, we bring you an excellent briefing by Alex Hanmer. Alex is an expert in revenue growth management with EY. Trading effectiveness is such an obviously important part of revenue growth management that I was delighted to get EY's input to the masterclass. EY has an exceptionally disciplined and effective approach and methodology to this subject. Here's Alex.
So my name is Alex Hanmer. I work for EY, and I'll give you a bit of background on me before I kick off. I've been at EY for 7 years now, focusing on commercial transformation, and that's been primarily in FMCGs. And we work with the big companies at FTSE, NASDAQ, globally. A lot of that commercial transformation revolves around revenue growth management. There are primarily 4 big issues. This session, we're going to focus on the first 3, and next session, we're going to focus on the last one. So growth is challenging, as I'm sure you guys all know. For a long time, ZBB has been the driver for growth, so the cost-cutting approach, which has been very good for the profitability line of companies, especially the kind of private equity-backed ones. But even those companies, when you look at them and look at the past 2-3 years, there hasn't really been any organic growth. And there's starting to become a challenge from the analysts and investors, which is this actually sustainable? Part of the problem around that growth is because competition is becoming intense. So from the supplier side, I think we have a stat that P&G used to look at 3-4 competitors. At the last count, we think they have about 1,000. So there's lots of local players taking small chunks out of their portfolio across the globe. And it's very hard for a company to restructure itself to think about how can I compete at that level. On the flip side, the retailers are also competing intensively. So you've got the discounters have come in and taken share of price. You've got people like Amazon taking share through the online business. And you've got 2 extremes there. You've got someone like Amazon that just wants market share, someone like the 3G-backed companies that just want profitability, and you guys are kind of stuck in the middle, being asked to do both. So you are in a very hard environment to survive. On top of that, you've got technology fueling disruption. So you've got an explosion of data coming from all over the place. Now that's a challenge because there's an heritage of data and analytics in CP companies. But I think it's gone from being a competitive edge to being a hygiene factor. If you can't look at data, if you're not leveraging data to help you compete, you're not going to reignite growth. So a lot of the work we do at EY is focus on that technology, the data, the analytics to be able to compete better, to be able to grow more effectively. And finally, as I said, on the next session, we'll talk a little bit about the operating models because refocusing your business towards a more kind of insight-driven, tech-driven, data-driven business requires a rethink on your operating model. There is about 350 billion of trade spend just on the top 30 CP companies in the world. And from EY's perspective, we think that's poorly managed. There isn't a strong enough ROI culture in that area. And we're seeing from analysts and investors that there's a bigger push for that bucket. So we've been moving up progressively through the P&L, doing shared service center, supply chain synchronization, zero-based budgeting, and that's all stripped out a lot of cost. But there's no cost left to strip. So the analysts and investors, they're asking us to look at trade spend and how can I improve that. But that's a different bucket of spend. You can't just strip that. You strip that, there's an impact. Your retailer is going to react, your consumer is going to react, and it's going to hit your volume and you might be worse off. So it's less about stripping out and more about how can I improve ROI, which is why this is so difficult. And this, our view, is where revenue management plays a role. It's focusing on that trade spend bucket, trying to increase return on investment as much as possible. RGM or NRM or whatever you want to call it, its aim is to get the right products in the right place at the right price with the right promotion. So that's what it's looking to do. But it's effectively doing that by translating the category and brand strategy and the route to consumer strategy into those customer plans. So that is the role of RGM. How can it take that strategy and translate that into tactical executional plans with retailers? There's a few levers it uses, so product, NPD, price pack architecture becoming progressively a bigger thing, You got place, so finding out what location to put stuff. And to Marc's point, all this kind of stuff is getting more granular. When we're talking about place, we see our GM now look at specific stores, specific shelves. It's no longer good enough to just think about gondola and one who's going to get me enough exposure. It's which gondola and ones are giving me more money. Are they all working effectively across every single store? So the leading businesses are now looking at real kind of store level information and micro-segmenting their customers alongside that. Which gets to our next price, which is price. So what's the consumer price strategy? And to my point, that's becoming micro-segmented. What is the consumer prepared to pay, and how can I structure my products, my promotions to those specific buckets of consumers? So are there stores in affluent areas, and therefore do I have a different strategy to those stores than I do somewhere else? And all that thinking has to come from our GM. And obviously the biggest driver are still promotions or trade term spend and your promotional ROI calendar. So still, that's where revenue management spends most of its time, trying to generate insights to help that bit of the business. So you got segmentation, you got like granular view of the consumer, but also your channels, your customers, and your products. So I think the key takeaway from this session from us would be that if you're not looking at all these things at a very granular level, you're not competitive enough. It's all about the aggregations of marginal gains. It's the little bits of wins that you can do here and there will collectively lead to profitable growth. When we've looked at different organizations, we've seen some common threads of what a good RGM team has. And the main one is it's independent of sales. So its role is to try and influence sale. It has a mandate to set some rules, set some guidelines, but it needs, in order to be able to do that, it needs to be trusted by sales. So it's not a police. You can no longer act as a police team. That team is supposed to be an insight generation and support function, but it has to have the power to influence sales. So we're talking about the leadership needs to be senior enough to be able to sit across the sales director and have a conversation with them and really influence him to make a change. He can't just be there generating the insights the sales team wants. He needs to generate the genuine insights in the industry and effectively push that message into the sales organization. So we've seen there's revenue management teams sit in sales, sometimes they sit in marketing, in occasion they sit in finance. For us, we don't really necessarily feel that there's any particular one that's better, but what we're saying, the important thing is that the senior leadership of the RGM team is senior enough and has enough influence and kind of can dictate conversation into sales. And finally, it owns and facilitates cross-functional demand plans and processes. So that's a long-winded way to say that it orchestrates the cycle. It sits in between sales, marketing, finance, supply chain, and its role is to get that whole business pointed towards the same plan. So we'll talk a little bit more about integrated business planning, but it's really RGM's role is to orchestrate that whole process so that the whole organization are working towards one plan. The whole thing is tied around the ROI Driven Investments. So it is RGM's function to a large extent to be able to gather the right data, process that data, and generate the insights. Having said that, and again, we'll touch upon this on the next session, we're seeing some of that being split as revenue management starts to focus more on insights and less on the generation of the analytics. But ROI is the key word. So if revenue management isn't thinking of ROI, it's not working. Its whole role is to introduce an ROI culture into the organization. Every dollar spent needs to kind of give some money back. Post-execution, it needs to evaluate what has worked, what hasn't worked, why has it worked, why hasn't it worked, and how can I influence the next cycle. It's about closing that loop. One of the big problems we see in organizations is that they're too busy with strategy planning and execution, and they don't do enough evaluation. So they just loop into the next cycle without having seen what worked and what hasn't worked. And I think too often sales has a license to fail by just recycling last year. And the business needs to move beyond that. It needs to be able to take more risks and do more trials and try different stuff. And it needs to have the license from the organization to be able to do that. And it does that by having the support from our GM to say, look, we genuinely think this is worthwhile going for. And it's our GM's role to convince the senior leadership, or at least to influence senior leadership, the marketing teams and everybody that potentially risky strategy may or may not be worth it. A lot of the trade promotion optimization, trade promotion management tools out there aren't really fit for purpose. I mean, they had a role to play maybe 10 years ago, and they were good enough back then, but these days is where they fail is that they're not collecting enough quality data in. They're picking up data off the financial systems, but the financial systems are there to reflect financial performance, not transactional performance. There isn't a responsibility or a mandate for finance team to release that promotional excess fund correctly. You've promoted one product, they just release it across the P&L. Their worry is to just recognize that cost appropriately, not recognize it in the specific transactional products or SKUs. So you end up pulling in distorted data into that, and you end up with distorted analytics. Leading organizations are in that space. So that 3-year plan you're talking about, if there's a recognition that we're going to have to outdo the market, there needs to be information being fed from our GM into your innovation pipeline 3 years out to consider how we're going to be able to achieve that, because our GM's role is to say to the business, with what we have, we can't hit that target. So let's think out 3-year time horizons and start to consider how we can start influencing that. But our GM has to be honest. It's the honest broker of the organization. The CEO might not like it, but that's the reality, and we need to do something different.
Can I just take you up on that honesty question? Because we often talk to clients about truth in budgeting, and this issue of you do all that bottom-up work and this is the plan you really think you can deliver. Now, part of the problem is top management thinks you're sandbagging a little bit, and so they think there's some more money there. I can't answer that. People do sandbag, and it needs to be challenged a little. But then when a top-down number is imposed on you, if that's unachievable, and quite often it is, quite often people know it can't be done, you end up with a budget that's not a real budget, and you've got what I call a try harder scenario. So you don't go back and recut the budget into a realistic thing that will deliver the number, because you know it can't. So you've got a plan you're working to that no one believes, and that becomes even more disconnected as the year progresses, because the reality starts to emerge.
So I think the big message from us here is the commercial context. If you're not taking a look at where you sit in a wider commercial, just beyond your firm, then your targets are more likely wrong, and your sales team have to carry out long-term destructive activities to hit that short-term target. It is a difficult message, it is difficult to have those conversations, but there is levels of sophistication you can bring in. Even if you're applying a gap, trying to close a gap, there is stuff like over and under indexing that you can use to appropriately allocate that gap, as opposed to just giving it to the big players. I think this is what we've been talking for a long time now, right? It is very hard to do planning because there's a number of variables in there. You need that horizontal alignment as well as the vertical one. So to your point, it's working back from that long-term plan. How do we connect all these different plans to make sure that you've got a consistent, integrated business plan? And at the same time, you're looking down into the business. So your long-term plan needs to map your integrated business plan, supply, demand, order management. And there's a number of functions included in there. So you got finance, R&D, supply chain. There's a lot that needs to be coordinated and connected together to be able to do an appropriate plan. And that's, we view revenue management's function as being able to orchestrate all that.
Besides the masterclass, the Institute collaborated with EY last year on a deep dive looking at revenue growth management. If you're interested in knowing more, the white paper, Revenue Growth Management, is available on our website. This is Marc Childs from FMCG Institute. Thanks for watching.